Long-term care insurance premiums are skyrocketing, and many who do apply are denied. Just where can older Americans turn to secure their financial future?
Click on the banner above to learn more about our sponsor, Fairway Independent Mortgage.
Right now, if you're in your mid-50s and healthy, a typical individual long-term care policy would cost around $3,000 a year. Even without premium increases, that would be close to $100,000 over 30 years. Those are the words of columnist Howard Gold in his September 16th MarketWatch column. Countless middle-aged workers have decided to protect their financial future against the cost of long-term care in their elder years by purchasing a long-term care insurance policy. It's a move that many financial advisors have actively encouraged over the years. But today, these policyholders are seeing huge premium increases as payouts for care increased and individuals kept the policies longer than the insurance companies anticipated. Some of the 8 million plus Americans who do have such a policy are facing a financial Sophie's choice, having to absorb the cost of continued premium hikes or to cancel their policies and lose the future benefit and the years of payments that were to secure, all at a significant financial loss. Now, those wishing to apply for coverage will find getting approved more difficult. According to the American Association for Long-Term Care Insurance, 44% to 51.5% of those who are over age 70 who apply are declined by the insurers, writes Gold. Now, the percentage of those who are declined drops to about 20%, or 1 in 5 for those in their 50s. So outside of purchasing a life insurance policy or an annuity that has a long-term care rider, those who do seek coverage will have to tap into existing assets, such as cash savings or investments. Where else can one turn to find the means to pay for future care in old age should they need it? Homeowners 60 and older could tap into what is likely their largest financial asset. That is their home's value with a federally insured HECM or a proprietary reverse mortgage loan. In his recent interview with Reverse Mortgage Daily, Lance Canada recounted, "I encountered many seniors who wanted to purchase LTC policies but could not afford them, so I started to research if there was a product that could help senior homeowners to be able to afford the kinds of LTC products that they wanted. This is what led me to the reverse mortgage." I reached out to Lance for further comment, and he shared the following. 1 out of 2 people will need long-term care. Unfortunately, many folks undersave, yet I never ran into anybody who didn't want to have long-term care coverage because many had friends who went through their money trying to take care of their long-term care expenses. The safest approach is to ask, what other financial planning have you done to prepare for aging in place? If they do express a concern, you can refer them to your trusted long-term care specialist. So, what can be done? An older homeowner could certainly use proceeds from a reverse mortgage to purchase a robust long-term care insurance policy, but they do risk facing increasing insurance premiums. There's another option, that is to partially self-insure, that's using the proceeds from the loan. Now, in that scenario, the homeowner would set up an open line of credit and leave all available funds to grow for future use, but that will require some considerable financial discipline from the homeowner so they avoid the temptation of taking withdrawals for other wants and needs during those years. But the fiscally conservative borrower could even double down more. That is to set aside a portion of their existing or their previous mortgage payment that was retired by the reverse mortgage and put it into a separate interest-bearing account, while at the same time the available line of credit continues to grow. And then at the time long-term care and medical expenses are to be paid, you can pull from the line of credit and the side account. There's pros and cons. The pros are that a reverse mortgage has no expensive premium payments, and that would not strain monthly cash flow. And there's no underwriting either. But the cons are that a reverse mortgage does consume a portion of the home's equity each and every month as the loan balance grows, and long-term care expenses could actually exceed the funds that are available in a reverse mortgage line of credit or a savings account. Either way, many find themselves in a proverbial catch-22. To finance long-term care, who could utilize a reverse mortgage and soften the financial shock of that care. So how do you see a reverse mortgage being best utilized strategically to address long-term care needs? You can leave your comments in the comment section below, and also if you would share this video with other professionals, you can do that using the social media links on this page. If you're on YouTube, be sure to subscribe, that way you never miss an upcoming episode. Thanks for joining us, and be sure to return next week for more reverse mortgage news, commentary, and analysis here at HECM World.